Andrew Horowitz, thanks so much for joining us on Wall Street Unplugged.
Hey, always a pleasure. By the way, Frank, I love your daily live videos on Twitter. That is just something.
Oh, thanks, man.
Yeah, doing a great job.
Yeah, and you can thank the guy who's taping this for us, who helped me out with that technology, who's Garrett, and yeah, it's just been amazing for us that we could share the screens and educate people, and it's resulting in a lot of people signing up, and it's pretty cool. It's just I
Well,
really
it's also the educational component. I mean, we've been doing, so one of the things I've been doing is this Monday pop-up Q&A webinar where we do it through like a Zoom platform through webinars, and anybody's invited to come and sit in on a quick recap of what's gone on in the week and then ask any question that they want. And it's, I mean, like totally jam-packed up to the level of my subscription for the webinars each and every week. So people are really, I think, yearning for that kind of information, don't you think?
Yeah, I think so. But, people don't have access to the things that we have access with. We've been doing this for decades, especially the research engines that we pay a lot of money for and stuff. And so we get, like, I could see the debt that's due on any single company in 30 seconds, right? Over the next 5 years, and a percentage of how much you generate cash flow. We see this stuff so quickly that I think when, you just have Yahoo Finance or a couple of like Finviz or something, I think people really appreciate it. So yeah, that's good. And hopefully more analysts keep doing it. I know you've been doing it too and doing a great job. So
Yeah.
And now in this market, right, where you mentioned it before we got in the air, nothing is normal or back to normal except for the stock market. So what's going on? Can this continue? And I'm just going to throw one thing at you because I know you love the economy. We always talk about it. We looked at May, personal spending up 8.2%, but yet May personal income down 4.2%. You just got to think about that for a second, guys, right? People are generating less but spending more. Why? Because the government is handing out checks. So could this continue? Because now we have this, it's not a second wave of the coronavirus. This should be expected. We're letting more people out. More people are going to get it. We don't have a vaccine for it. So we have to develop herd immunity. We don't know if vaccine could take 12 months, 18 months. And we all know that we can't just close the economy and everyone stay home for 6 months. That's going to be more damaging than ever. What are your thoughts on what's going on? And can the market continue on this road of, it's not a recovery. I mean, we're trading at all-time highs pretty much right now.
There is a total dysfunction when it comes to trying to understand what the numbers are for the stock market and with the economy. The problem is that there is an inability for any analyst to properly predict right now the information with regard to the economic analysis, because it's almost like there's a lot of data points that have been created out of midair all of a sudden that are not allowing for normal calculation. And as such, there is this kind of question of, hey, wait a minute, if we are going to open up and if we do see a V recovery or rolling W's, which we think is more likely, eventually, maybe 2022, we're going to be back to quote unquote normal. And why not just put the money in the markets right now, find decent stocks that can withstand all the problems and pressures, and with all of the excess stimulus that's being pushed in. I mean, we're talking about multiple of trillions of dollars, not just here in the United States, but around the world. And that liquidity that's being created out of thin air and is trickling down into various markets, whether it's the bond market or the stock market. I think there's a euphoria out there. Plus, you have to realize that by their very nature, there's a lot of gamblers out there, and there's not a lot of places to gamble right now. So they're putting the money into the stock market, which is an open and running gambling process on a daily basis. At least that's how they're looking at it. So, I mean, I think that there is a lot of optimism built in. Every time we get a good number, things really do well. A bad number is like, okay, it's, not so terrible. We're not really worried that we see this major spike in Texas and Arizona and Florida, and that the EU is saying, hey, United States, you can't come here. And New York, New Jersey, Connecticut saying, hey, you know what? Hey, we don't want you flying in here. If you do, you have to do a 14-day confinement or quarantine. So there's a lot of mixed messages that are happening here. But I think what the one thing that is the base of all this is that the hope for recovery sometime in the future, whether it be a natural process or pushed in by the government, is helping the markets that may be totally entirely dislocated from the economic reality, which is a little weird. And I don't know if that's going to really come back to normal anytime soon.
So here's a $65,000 question here. So how do you position your clients? Because right now you're seeing more money on the sidelines than ever, right? In money market accounts. And it makes sense because you're a retiree and you're giving advice to these people. It's hard to tell them to buy Disney at 240 times forward earnings. It really is trading at 240 times earnings. And that might be cheaper than expected because I have no idea how they're generating earnings right now with everything closed. And you're looking at casinos, you're looking at cruise lines, you're looking at airlines, where now at least you're seeing separation where you have the Deltas and the Southwest are in much better shape than the rest of the industry in terms of the balance sheet. But what do you tell your clients? Because it's almost like you're basing it on the hope that the Fed's going to continue to extend checks, right? Which in July, to extend that the small business loans, continue to buy bonds in this market, something that we haven't seen ever, right? I mean, we saw a little bit about just in finance and they backed the finance. I mean, guys, just to put in perspective, and you notice, Andrew, that TARP was originally 700 billion. They only used 480 billion of that. We're at 6 trillion in monetary and fiscal right now, and we're not even close to being. That's 30% of GDP.
30%.
So what do you tell your clients? Because you're basing this on something that you're hoping that has to happen because you have to buy stocks that, I mean, I thought Shopify was expensive at 2,500 times forward earnings. Now it's at 5,000 times forward earnings because it doubled. What do you tell your clients?
So there's a couple of different things. First of all, we're flying blind. Let's just get that straight. We are totally flying by instrumentation only, right? The ILS, I think it's called. Systems that are going on right now. We don't know. I mean, FedEx came out with earnings and they blew past estimates by a really wide margin. But I looked at this and from what I saw, that the FedEx earnings that came in at $2.63 a share, they were like 91 cents above estimates, and they saw a little bit of slowdown on revenue. They're not putting out guidance. Last year at this time, they were at $5 a share. So they had a 50% cut in their overall earnings. Stock is trading at about $155 a share. Last year at the same time, it was $170. Stock is only down about, 10, 12% from where it was. Meanwhile, their earnings are down 50%. So that's kind of a little crazy. Well, what I'm telling clients is that we have to do a couple different things. First of all, we do this whole 1 foot in and 1 foot out concept where we're going to play along, but we're not going to be crazy about this. We're going to be satisfied with getting a decent return, having a lower exposure to equities, trying to position ourselves in a way that is not going to get our heads chopped off in the event that something happens that mimics reality versus what we're seeing now, but at the same time being a part of it because it's not a short-term game. The second thing is I think that you have to realize is that, from time to time in our trading portfolios and the managed growth strategy that we have, we do some hedging. So we're short the S&P against long positions of equities right now. We have a small position short, for example, Roku recently, and we have a short on Shake Shack, and we have longs on, for example, let's see, what was the long that I was looking at recently? Oh, so we have a long trading position in for example, I'm drawing a blank on the name. Anyway, we have kind of a mixed bag in our portfolio. 1 foot in, 1 foot out on all sides, and a little bit more of a conservative posturing right now for our other portfolios, and clients are really happy with that. We don't need to necessarily get all the return of the S&P 500, what everybody's always talking about, as long as we don't take the downside either. So we're kind of positioned that way because these unknowns that we have right now, if I can't tell you, Frank, if I can't give you good reason and good rationale for a particular stock or for a sector or for the market itself, and I can't explain why we're there without saying, well, we're just hoping that this is going to work out, I'm not doing my job as an advisor. So I make sure to keep that really tight.
And that makes sense too. I mean, because, and that sets it up for this question too, is even the long names that you're looking at. I mean, what are the next winners in that post-COVID-19 world where, you mentioned to me that, hey, we already know the stay-at-home plays. We know that they're doing well. We're seeing a lot of the biotechs really, do well. They did well already. They pulled back a little bit. The biotechs associated with vaccine. Now that coronavirus actually, we're seeing spread again. We're seeing a lot of those names go, move higher. But what's the post plays? I mean, is the Nasdaq deserve to be trading where it is, where there are a lot of software companies? There's a Zooms that make sense. The Zoom numbers, yes, it's expensive, but those numbers were incredibly explosive that they reported. Yep. They've been growing like crazy. Good for them. That's what they want to see. As long as you have that growth, you're going to have that high premium. But what what are the next winners? I guess that's what all of us want to know.
So I think that you have a lot of things going on, like a FLIR as an example, a company that does thermal imaging. Interesting possibility there for the placement of various devices in, whether it's in casinos, whether it's in hotels, restaurants, or airports, cruise lines, to make sure that people are not coming in hot, feverish. A company like Trane, the old Ingersoll Rand, which does various heating and cooling for buildings and for homes, whereas, you're going to have a filtration system. I mean, just today, New York said, hey, you know what? We're not really even thinking about reopening dine-in restaurants. And I think New Jersey yesterday said something about they're holding off indefinitely on opening up the dine-in restaurants. So a company like a Trane, TT is a symbol there, we just started looking at this. The idea about sanitation, cleanliness of air quality, air filtration is kind of an interesting thing. Autonomous driving, the whole concept there. Recently, a big purchase by Amazon, trying to get into that realm where you can have deliveries with people that are not there. I mean, just autonomous driving of deliveries or of transportation. I mean, there's a lot of potential winners and losers. I'm having a hard time, though, necessarily trying to handicap all that, because you wonder whether or not once we get back to normal, if a lot of this stuff, if we have a short-term memory, because we do have a short-term memory. We know that, right? I mean, we go through these processes and remember back when that nobody wanted to invest in banks for a while, and then all of a sudden everybody wants to invest in banks again. And nobody's going to want to invest in cruise lines or airlines for a while, but then, time will go by and they'll invest in those again and they'll go on those again. So I think there are some winners and losers in all of this. The big loser that I see is probably commercial real estate in the metropolitan areas. The winners will be those companies that are building for the deurbanization process, possibly throughout the country, where people are saying, you know what, I don't want to live in these metro areas. Restaurant chains are going to have a long time getting back to where it is. Movie theaters are going to be a problem. So, there's kind of a lot of this one's going to be a problem, but this one's going to benefit. This one's going to be a problem. And that's why we're seeing kind of a bifurcated market right now. Whereas the NASDAQ, the growth stocks, the technology, the healthcare, biotech is doing really well. Your oil companies, your banks, consumer staples to a lesser degree are not doing as well. And then in between all that, you have your consumer discretionary that who knows why Gap was up 75% last week. A lot of rumors and things going on there.
Kanye West.
Well, yeah, woohoo. So I know I'm buying some Gap clothes now. But, there's, I think, a grouping of winners or losers, at least that's trying to be handicapped by the market at this present time. But there are some long-standing changes that are going to happen in the next version of the world that we're in. And I think there's going to be a lot more focus on health. The whole idea of being cooped up, locked down, not able to go out and do what you want to do. I don't know about you, but, this was supposed to be from March to April. Remember, we were supposed to reopen on Easter, the grand reopening. We're in July. I mean, this is much longer than was anticipated, getting back to normal. And now we're seeing rollbacks in Texas and Florida and Arizona, Georgia. But it seems to me that we're going to be pushed more towards online. Markets are telling us that. Much more towards software as a service, much more towards entertainment at home. And possibly travel locally. That's why you're seeing a lot of sales of those Winnebagos, boats. Can't get your hands on boats down here.
Even cars. I mean, they said some car dealerships said they're going to close 4th of July because they have no inventory. I mean, people just are not taking public transportation. You can't really take airlines. Are nervous. So, hey, just throw everyone in the car and let's go someplace.
Let's go. Exactly.
I mean, it is amazing. It really is amazing to see what's going on right now. But so let's talk about something that's going on right now. I had a big rant on it before I meant to which is how, the social media, you call it, I think you mentioned it, day reckoning. I just love the hypocrisy.
Did you say
all these companies?
You're talking about the sewer media?
Yeah, I'm talking social.
Oh, I thought you said sewer media.
No,
I call
social
it sewer
media. Facebook, it's same thing, right? And
right.
We're on these platforms. I see it as well. I just block so many people because it's just it's just crazy. It's unbelievable. But anyway, Yeah, the hypocrisy behind these companies that are coming out, like the Coca-Colas, the Pfizer's, the Verizons, the Microsofts, and all the racial injustice lawsuits that got launched against them and settled, and all the fraud. I just think it's amazing. But
Yeah.
Is this a big deal for Facebook? We saw the regulatory issues with Facebook, and hey, they overcame it. With this, with a platform where everyone is telling you exactly where they are at that second and what they like, what they don't like, and you have basically, it's, what is it, 30% of the world's population on it when you include Instagram. Is this is this going to be a trend that's going to continue that could really hurt Facebook, which is going to hurt them now? Or is it just like, hey, you know what, this is just a flavor of the day? And a lot of companies, of course, they're not making these announcements. They're making them as public as possible because they see polls saying that, hey, if you support, whatever it is, we'll, again, I covered that in my intro. But what are your thoughts on social media companies, including, Facebook and Twitter?
So I think what you're talking about is the idea that, or the question of whether or not this is a real revolution or if it's just virtue signaling by many of these companies that are saying, you know what, we're going to pause. Now that's the key word right now, right? We're going to pause our advertising on Facebook until when? I don't know when. Maybe it's a combination of two things. I think it is some virtue signaling by these companies trying to get in the good graces, the whole ESG thing. I also think it's really good and convenient timing where these companies need to pull back on some of their advertising so it doesn't make it look like they're doing this because they're hurting, right? So it's a really convenient time for Clorox to say, you know what, we're going to postpone and cancel or pause our advertising through the end of 2020. And it's like, oh, you're doing it because you want Facebook to be fixed and you want to stop all the hate speech and all the misinformation rather than, oh, wait a minute, are you hurting and you want to clean up some of your expenses? So I think there's kind of a question there. I do believe that Facebook is one of the best, I don't like it personally, but one of the best places to advertise because you have targeted advertising. Where else are people essentially providing you all of the information about themselves, where they're going, what they're doing, who their friends are, what they like, what they don't like on a regular basis, where you could just sell to advertisers and totally target market them. So Facebook has that whole process done better than anybody else. A lot of the analysts that are coming out recently have said, hey, you know what, this is not a problem for Facebook. Now, I don't know how it's not a problem if we have companies like Starbucks and Clorox and, the whole litany of companies that have said, you know what, we're pausing at least for a month, if not longer, all of our advertising on Facebook and Instagram. It's got to hurt. It's got to be a problem. And Facebook already told us that there's a problem time and time again with a slowdown of their advertising and a requirement to build up in terms of expense-wise their overall core grouping to combat this. So we are entering into a political season where it's going to be a lot of political advertising that's going to be spent on that, but yet they may be doing a lot more censorship. So I think the bloom is off the rose a bit for Facebook. I don't know if it's going to crater the stock and be the next MySpace. Twitter, there's much less targeting of advertising available on Twitter. I think that, they have some information on you, but it's very, very minor. Maybe their algorithms can pick up who your friends are and start to build a bit of a structure around where you are and what you like and all. But you look at that, Snap, questionable. Instagram still in its infancy of trying to get the advertised, but there you have a much different situation. There you have a lot more people that are being followed for, people like to follow that particular party. So all they have to do is themselves advertise something and the buying goes on. So I think this is a big hiccup for Facebook. Seemingly the markets and the analysts aren't that concerned. I am hoping, and I'm hoping with a squint, because I don't think it's going to change, but I'm hoping they do change the platform to a point that there is less hate, there is less misinformation, but I don't think the probability is that will last very long. And I think the only thing that we have to look at now is the potential for regulators to really get in there and do something. And I'm not sure what they're going to do, but there needs to be some changes. But I just don't imagine in the world that we live in, there's going to be that many changes that's going to hurt Facebook. There's really no other alternative. People are not going back to legacy TV to advertise, are they?
No. And you bring up a good point, Andrew, because it's when you market it, it's usually a percentage of sales, and most companies are seeing a decline in sales, so they have to cut their advertising budgets. Where you're going to see sales explode for some companies, maybe the Microsofts and software companies and Amazons and Walmarts, but most companies are seeing a decline in sales.
Right.
So You're going to see that. You saw that on platforms, on even the bigger names, not so much the social media, it's advertising platforms, but just into public groups, that got killed and it came back a little bit. But yeah, no, it is interesting to see. And I know a lot of people own these companies and looking to buy Facebook on a pullback. Again, our job is to talk about stocks and everything. And we understand.
We own by the way, I own Facebook for our managed growth strategy. And the reason is that the consistency of earnings, the quality of earnings, the growth rates, the comparatives, the margins, the margin expansion, the ability of the company to make money is there, even though I don't like the company at all. We own a small piece of it for client portfolios.
So let's move on. I want to talk about two more topics here. One, I want to get your ideas like I always do. But before that, let's talk about the election. I mean, it's meaningless now to see the polls have the Democrats winning. But if there's a Democratic sweep, is that priced into the markets? Because we are going to see, taxes are going to be different. Gun rights may be different. Defunding police departments might get even more aggressive. There's definitely a different agenda, just like if, guys who support Democrats or Republicans or whatever, if Republicans win, then you're going to see, whatever agenda. But there's a lot of things that are going to change, right? Especially with a Democratic sweep, which is pricing it in right now. And again, that's meaningless because there hasn't been any debates. But talk about your thoughts on the election and say if Biden does win, are we going to see a big impact on the markets, you think?
So remember something, that when we were handicapping the last election, the idea of a Trump win.
It was so wrong.
Right. Well, for 5 minutes, we were right. And then it was all over, right? Because what happened was that Trump came in with all this radical ideas and all these things that were going to happen. Markets freaked out. We did see a drop of the futures on the election results that locked down the futures for a moment. Then Trump came out like I don't know what it was, 3:30 in the morning or some ridiculous time, talking already about tax cuts. And the agenda the Republicans were supposed to have, which was supposed to be to rein in the Federal Reserve, to bring interest rates up, to take down the debt of the country, that all turned on a dime into, you know what? Let's just have a Federal Reserve that has a lower interest rates. Let's push them to the limit on that. Let's then go from there. And we're going to have a tax cut for corporations and somehow benefit the individuals, which didn't really play out, but okay. And then it's turned into almost a modern monetary policy, a theory type of government where the spending is more with this administration, even before the coronavirus, than it was with any other Democrat in history. So we have a lot of spending that went on. We have tax cuts that went on. So there was a big change. Now, if a Democrat comes in and if there is a Democratic sweep, is there going to be a rollback of the taxes? Is there going to be an increase in that? I mean, I think that's what they talk about, but Democrats have really never been able to do that. When's the last time a Democrat really raised taxes? Very hard pressed to do so. When is the last time a Democrat reined in spending? I don't see it. Now, if you want to say, well, they'll be more responsible, I don't even know how the most I don't even see how the most fiscally responsible person at all right now could even look at the economy where we are in the whole and say we have to rein in spending. It doesn't make any sense. The economy is running on.
You're going to say everything to get elected. You're right. You're going to say everything right now to get elected. But
yeah. So I mean,
there's no way you could raise. You're not right now with the economy this bad and saying you're going to cut spending and raise interest. Interest rates have to stay low. They have to stay low.
Yeah.
On the balance
I agree
right now. So and they're smart about that. They'll talk to them, but again, talking and doing are two totally different things. No matter which party you support. But
I won't even try to get into who's going to win and who won't and what is going to be the situation. I don't really know unless there's a big reversal in taxes and interest rates change dramatically and we pull back spending in an incredible way. I mean, maybe that would do something, and it would, obviously. But I'm not ready to call that being their platform because, to be honest with you, neither President Trump nor Biden has come out with a platform yet. It's just a big rally, yoo-hoo, let's go, let's get it done. The other guy's bad, I'm better, but we're not seeing any platforms.
Yeah, if guys, you listen to me or even Andrew, I mean, when it comes to the consensus and being a contrarian investor, I mean, listen, the consensus right now is for the Democrats to win. If they win, the market's going to crash. That's the consensus, right? But the consensus was when Trump was going to win, the market was going to crash due to uncertainty and gold was going to surge. Right. And there's no one that said, oh, I hope Trump gets, nobody. I know, I cover the markets. I cover everybody out there. I didn't see any headlines. Wow, if Trump wins, this market is going to surge. Nobody said that. So the fact that we're saying that, again, that consensus probably means that if Biden does win, it might be very good for the markets if you're a contrarian investor. So just, you want to bring up the positives and negatives, but everybody got that wrong. You're right with Trump, including me. So, it's just amazing that the markets continue to move higher here. Okay, last thing here, and thanks so much for staying on for so long. Usually we try to keep these things just 20 minutes. It's a little bit longer, which is awesome. Thanks, buddy. Some of your favorite plays. You mentioned Train Technologies as one. I like that. Air filtration and just that's a good play. You looking at anything else? I mean, I know you mentioned usually, we provide bullets to each other when we're interviewing, and you said, Lululemon's purchase of Mira was very interesting. But what are some of the things, individual names that you could share with some of our subscribers? And some of them you already shared. So I don't know if you have any more.
I mean, Lululemon is interesting. I mean, this is a company that has done really well. It's really has great product, great history, great management. Recently bought this mirror product for about $500 million, which is kind of stand in front of it and you squat and you stretch and you jump and you run and you punch and you do all this stuff. It opens up a really interesting now situation where that can be not a competitor, but an adjunct to the Peloton, where it's the same kind of thing. So you buy this mirror for X amount of dollars and you pay $39 a month. So the company is actually very healthy. This is going to add to the bottom line of Lulu. And I think, though, there's a kind of the other side of the mirror, if you will, which is that gyms like a Planet Fitness, I just do not see how a Planet Fitness, which is a lot of a franchise, by the way, they're a big franchise operation. Most of the franchises make like 25 to 30,000 net afterwards. They have a big overhead with social distancing, with the issues that are going on right now, with the people's desire, first of all, to work at home. Well, you might as well just stay home and have my Peloton or my mirror or my other, workout gym at my house if I can do so. I think there's going to be a trend that way. So I'm kind of like on a Lulu or a Peloton positive, on a Planet Fitness negative. I mentioned Fleer, of course, in that discussion as well. And Train is something that's kind of an interesting positioning. I mean, your healthcare, your various healthcare companies, I think, are also going to have a real good bid to them. Not the outlier biotechs, but the kind of core companies. Pfizer had a good announcement about something today. It popped the stock. You get to see that. I mean, I'm still a big fan of like CRISPR Technologies, which does genetic editing.
Had that for a long time. Yep. Mm-hmm.
Yep. I've had that for a while. It's hit an all-time high just recently. Did a secondary this week. Stock is holding up really well. I think that's a really interesting play. Some of the restaurants that are like in Northeast, et cetera, like a Shake Shack, short, negative on that for the near term. So, the one thing can I just branch over to something that I want to talk about just for a moment?
Go. Yeah.
Because I think this is something that, we've talked about the whole idea of what the Fed is doing right now and how they're, lifting up by buying ETFs. And now they're buying individual securities, and this whole idea of buying individual bonds. And they recently targeted and started buying Microsoft and Apple, Home Depot, Verizon, and Visa bonds. Now, tell me something, Frank. Do those companies have any problem going out to the debt markets and getting financing?
No, but those are the companies that are going to support the market and keep it high, probably.
Correct.
Spend, right? So
here's my thinking. The Fed goes out and starts purchasing this through an index-style investing. Okay, why do they kind of target these companies? Well, it's a backdoor bailout of the stock market because these companies are actively involved in share buyback programs. They could issue debt at very low rates now, take the money, and then do share buybacks. And when you have a Microsoft and an Apple and a Home Depot, for example, doing share buybacks, it's kind of like helps the market stay higher because most market indices are cap weighted. And therefore, when you move up Apple and Microsoft, the whole market comes up with it, right? So I think this was kind of like another backdoor bailout, just like we saw a backdoor bailout of the banks with the PPP program, and the continuation of a bank bailout with the bond purchase program through ETFs, because the banks are a big part of what they were buying through ETFs and through their other various programs. So, the Fed has been very involved with a very heavy hand. The question is, when the music stops, are there going to be chairs for everybody? That's the big question right now going into, I think, the next couple of quarters. I don't know how much longer the Fed can continue doing this without some scrutiny, because we're already at a decent level on markets, valuation stretched, and just doing what they do doesn't necessarily help the economy. It helps out the markets. There's a lot more fiscal that needs to be done. And some of the fiscal is being done because, of course, of low interest rates. You can do so. So I'm just saying it's kind of interesting what's happening. Everybody should just keep their eyes open to the reality of what's really going on here, to understand that there is a safety net to a point. But, once that stops, where do we go from there? That's a big question of mine.
Yeah, no, it definitely makes sense. And just to see, and that's how we're all thinking, like, how do we play this where there's a variable that never really existed to move stocks, where it's usually earnings drive stocks. Earnings are not driving stocks. Earnings are much, 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 much lower. And now it's being pushed out, not through 2021, but to 2022 to get to pre-coronavirus levels. Yet a lot of these stocks are moving higher, which, is something that flies in the face pretty much of, 100 years of market research, which is pretty crazy. But talked about a lot, covered a lot. I love that you share ideas, and my audience always loves you because you always do so. If they want to find out more information about you, Andrew, how can they do that?
Go over to thedisciplinedinvestor.com. We got the Disciplined Investor podcast. We got the Friday. I do some technical analysis training on Fridays through our subsidiary called Trigger Charts. Also on Mondays, the pop-up Q&A webinar. If you want to register for that, just go over to thedisciplinedinvestor.com. And yes, we manage money, by the way. So if you're interested in having us manage your money, there's plenty of information on our various strategies over on TDI or thedisciplinedinvestor.com. So check it out.
Awesome stuff. And I'm still waiting for that invite on your boat. I know it's pretty crazy and I'll wear a mask, but I'm sick of watching those pictures of you catching massive fish. And I want to get out there with you. So just let me know when, okay?
All right. You're on.
All right, man. I'll talk to you soon. Thanks.